We are looking at transfer pricing policy. Yesterday, Sunday class. Let me try to explain this Sunday class. Yesterday class was meant for our Victoria Island Student Center. Normally, we conduct physical class at that center. For some reasons, not within the control of equity professional, we have to conduct online classes yesterday for our Victoria Island Center students. At that class, we have started transfer pricing, which we rounded up yesterday. But at your class, like I explained to those in class yesterday, that the topic will be treated fully today. I'm aware that some of you joined yesterday. Some of you may not join. But we are going to try as much as possible to carry ourselves along. So the topic is transfer pricing. What is this topic all about? What is transfer pricing decision? What is it trying to teach us? If you look at some companies are operated on divisional structure. Some companies are operated on the basis of divisions. A good example is Dangote company. Dangote groups of company. If you look at Dangote, we have different divisions of Dangote. We have Dangote Cement. We have Dangote Salt. We have Dangote Sugar, Dangote Transport, Dangote Spaghetti, Dangote Petroleum. Dangote as a company is operated along divisional structure. Now the question is, if Dangote Sugar is selling sugar to Dangote Spaghetti, or Dangote drinks, if Dangote Sugar is selling sugar to Dangote Spaghetti, assuming you require sugar to produce spaghetti. Now the question is, at what price will Dangote Sugar sell sugar to Dangote Spaghetti? Remember that both companies, both divisions belong to the same organization. At what price will Dangote Sugar be selling sugar to Dangote Spaghetti? the price at which divisions of the same organization buy and sell is what we call transfer price. You can define transfer price as the price at which goods or services are exchanged between two divisions of the same organization. The price at which one division will sell goods to another division of the same organization. That is the transfer price. Transfer price is the monetary value attached to the goods or services produced by one division and sell to another division within the same organization. That is transfer price. To one division, transfer price will create internal income. To the next division, transfer price will create internal purchase cost. Let me explain that again. Dangote Sugar is selling sugar to Dangote Flour. Dangote Sugar is selling sugar to Dangote Flour. That means Dangote Flour is buying sugar from Dangote Sugar. To Dangote Sugar, that will create internal income. To the selling division, income is generated. To the buying division, cost is incurred. What is income to one division is cost to another division. Please note this point. What is income to division A is a cost incurred by division B. To the company as a whole, interdivisional transaction will not have any impact. To the company as a whole, interdivisional transaction does not create profit for the company. Please write this down. Interdivisional transaction will not create income for the company as a whole, because what is income to division A is a cost to division B. The cost will cancel out the income. Hence, the company as a whole will not generate any profit from internal sales. The company as a whole will not generate any profit from interdivisional transaction. This point should be well noted. What are the conditions for transfer pricing? Number one condition, the organization must adopt a divisional structure. Number one condition for transfer pricing is that the organization must adopt a divisional structure. Number two condition, divisions must be autonomous in nature. Divisions must be independent. Dangote Cement is an independent company. Dangote Sugar is an independent company. Dangote Salt is an independent company. Number three, point, divisions must either be identified as a profit center or investment center. Divisions can either be a profit center or an investment center. Divisions can never be a cost center. Point number 4. One division must manufacture a component or sub-assembly which is required by another division for the purpose of its final products. For you to talk of transfer pricing, one division must produce a component that is required by another division within the same organization for the purpose of its final products. Then condition 5, divisional managers must be willing and ready to transact business with each other. Just 1 minute. So please note the conditions for transfer pricing. Our next discussion, qualities of good transfer. What are the qualities of a good transfer price? 1, a good transfer price must allow for performance evaluation. Number 1, a good transfer price must allow for performance what? Evaluation. We must be able to use the transfer price to evaluate the performance of number 2. A good transfer price must guarantee divisional independence or autonomy. A good transfer price must guarantee divisional independence. Division 1 must be independent. Division 2 must be independent. Number 3, a good transfer price must encourage initiative and motivation. A good transfer price must encourage initiative, and it must motivate the divisional manager. Lastly, a good transfer price must promote Go Congress. Number 4, a good transfer price must promote Go Congress. That is Go alignment. The objective of the divisions must be in line with the objective of the company as a whole. That is Go alignment. Both the company and all the divisions must have the same objective. All right. We have defined transfer pricing. We have explained the conditions for transfer price. We have explained qualities of good transfer pricing. Our next discussion, method of transfer pricing. 1, cost-based transfer price. What is cost-based transfer price? A situation where transfer price between the buying division and the selling division is based on the cost of production. Cost-based transfer price. A situation where the transfer price between the selling division and the buying division is based on the cost of production or the cost of manufacture of the selling division. That is cost-based transfer price. But you must note that where transfer price is based on cost, the selling divisional manager will not be motivated. Manager of the selling division will be discouraged. If you manufacture your product for 100 naira, you are now asked to sell it for 100 naira. You manufacture a product. The manufacturing cost is 1,000. You are now asked to sell the product for 1,000. That means you are not making profits. As the manager of the selling division, you will not be motivated. But we have cost-based transfer price. Number 2 method, market-based transfer price. Number 2 method, market-based transfer price. Under this method, the transfer price between the selling division and the buying division will be based on the prevailing market price of the products. Under this method, the relevant transfer price between the selling division and the buying division will be based on the prevailing market price of the items to be transferred internally. That means there's an external market for the items to be transferred internally. External customers are willing to buy the product of the selling division. External customers are willing to buy the products of the selling division. There's an external market price, the prevailing market price. All right. Please note, under the market-based transfer price, there are two types of external markets. Under the market-based transfer price, there are two types of external markets. One, we have perfect external markets. And two, we have imperfect external markets. We have to explain this with illustration. We are going to explain this with a small illustration. What is perfect external market? A perfect external market is a situation where it is possible for the selling division to sell all its output fully at the external markets. A situation where it is possible for the selling division to sell all its outputs fully at the external markets at the prevailing market price. In that case, we have a perfect external market. In that case, we have a perfect external market. In a situation where you have a perfect external market, in a situation where you have a perfect external market, and you want to transfer items internally, the ID transfer price for interdivisional transaction is the prevailing market price. The ID transfer price for the items to be transferred internally is the prevailing market price of the items, or prevailing market price less cost savings, or prevailing market price less cost savings. Cost savings in packaging, distribution, and transportation. Let us illustrate this. Let us illustrate All right. Please look at this illustration very well. These diets, like I mentioned in the physical class, you are likely to have a question on transfer pricing. The examiner, okay, let me do it here. The examiner is likely to text you on transfer pricing. Now, market base. Let me do the illustration here. All right, look at this. We have perfect external markets. Assuming we have division X, maximum capacity 200,000 units. That is the maximum capacity production of division X. External demand from customers outside, 200,000 units. This is what we call a perfect external market situation. A perfect external market situation. In this case, if you are required to transfer items internally, you are going to transfer ID transfer price will be prevailing market price. If the market price is 1,000, external customer is willing to buy for 1,000. Then if you want to transfer internally, you are going to transfer at 1,000 naira. Or prevailing market price less cost savings in packaging, distribution, and transportation. Please, I'm making effort to write this thing. Why I'm writing this is because I want this understanding to sink. I want you to understand this thing clearly. Prevailing market price, less cost savings. Let me explain that. Let's use a practical example. We have John Oates Engineering that manufacture and sell generator. We now have John Oates Ventures Both companies belong to the same, both divisions belong to the same company, John Oat PSC. Under John Oat PSC, we have John Oat Engineering. We have John Oat Ventures. John Oat Engineering is now selling generator to John Oat Ventures. To sell this generator, it is not a must to package the generator because the two divisions belong to the same company. So if you are selling to John Oat Ventures, you can give them the generator without packaging. You don't need to package generator inside carton. That means if you are selling to John Oat Ventures, you are not going to incur packaging cost. You are going to give them generator without packaging. You are not going to incur distribution cost or transportation cost. So if you are selling to your own division, you can do market price, less cost savings in packaging, distribution, and transportation, provided you have a perfect external market situation. Number 2, in perfect market situation. Yes, your question, sir. Ablatif.
Sir, thank you, sir. Can you hear me, sir?
Yes, we can hear you.
Okay, thank you, sir. I just want to raise a question on what you have just said about the perfect market, where you said if they are selling to another division, it should be at prevailing market price, less cost savings, like transportation, packaging, and distribution costs. But, sir, I want to believe that these divisions are not on the same location. And to get item from one division to another, it will cost them to transport it.
All right, sir. Are you done, sir?
Yes, sir. Yes, sir.
All right. You are, yes, you are right in terms of practicality. But you also need to know that if you want to sell, assuming you are in your own ventures, Ventures is based in Ibadan. John Oat Ventures is based in Ibadan. While John Oat Engineering is based in Lagos. You now want to buy generator from John Oat Ventures, from John Oat Engineering. What will happen is that you are going to come yourself from Ibadan to their own office and carry your generator. In that case, John Oat Engineering will not deliver the machine to you again. That means you have incurred the cost yourself. John Oat Engineering will not charge you transportation cost again. They will give you the generator without being packaged so as to reduce your cost. Because you don't require the carton for anything. Even for us, I bought generator. You are giving me carton. What am I going to do with the carton? But because I'm an external customer, you must package it for me. The carton is of no value. After you get to your house, you are going to dispose it off. All right, thank you for the question. Number 2, imperfect external market situation. Under imperfect external market, a situation where the selling division has external markets but cannot sell all its outputs fully at the external market at the prevailing market price. Situation where the selling division has external market for its products but cannot sell all its output fully at the external market at the prevailing market price. In that situation, there's going to be spare capacity or excess capacity. Look at it, please. Division Y, maximum capacity 100,000 units. External demand 80,000 units. The difference 20,000 units is called spare capacity or they call it excess capacity. This is imperfect market situation. In a situation of this nature, where you have spare capacity, in a situation of this nature, where there is spare capacity or excess capacity, please note, ID transfer price for spare capacity is variable cost of manufacture. Please write this down somewhere in your book. The ID transfer price for spare capacity, about calling ICAN, because we got to round up your syllabus. So please note the ID transfer price for spare capacity is the variable cost of manufacture, although selling divisional manager may be demotivated. Please note this. When examiner want to test question on transfer price, it is usually market based. Please note this. Most question on transfer price is usually market based transfer pricing. All right. Other method. Number 3, negotiated transfer price. That one is very direct. The transfer price is agreed between the selling divisional manager and the buying divisional manager after negotiation. Both the manager of the selling division and the manager of the buying division will come to agreements through negotiation. That is negotiated transfer price. Number 4, arbitrary transfer price. This is the transfer price determined by the central management. Arbitrary transfer price, a transfer price determined by the management, the head office management, with or without the consent of the divisional manager. Transfer price determined by the central management with or without the consent of the divisional managers. Usually, arbitrary transfer price will happen where both managers cannot agree a price. Then the head office will determine price for them. Head office will determine the price. That division A sell goods to division B at 50 naira. Division B buy at 50 naira. That's all. And both divisions must comply because they report towards the central management. Lastly, transfer price based on opportunity cost. Transfer price on the basis of what? Opportunity cost. A situation where opportunity cost will be taken into consideration. In calculating the transfer price. In this case, your transfer price based on opportunity cost will be calculated as, look at it. Let me illustrate small. Ooh. God have mercy on us. transfer price based on opportunity cost is equal to variable cost of manufacture plus opportunity costs of transferring internally. Please note, if examiner says transfer price based on opportunity cost, that will still give you the market price. Hello, guys. If examiner says transfer price based on opportunity cost, by the time you do your calculation, you are still going to get back the market price. Because opportunity cost, instead of me selling to outsider, I want to sell to my internal customer within the same organization. The opportunity cost is that if I don't sell to outsider, or at what price will I sell to outsider? What is the profit I'm going to make if I sell to outsider? That profit, that means if I sell to insider, I'm going to lose that profit. That profit loss is the opportunity cost to be added back to my variable cost. By the time you add back variable cost and the opportunity cost of profit loss, that will give you back the market price. So in exam, if examiner says transfer price based on opportunity cost, just go and look for the market price and pick it. That's all. All right. To round up this discussion, how to identify optimal transfer pricing. Identify. Okay, maybe I should, let me close my video small. Identifying ID transfer price. 1. The rules you can follow if you are to identify ID transfer price. Number 1 is start by identifying the arrangement for transferring goods internally that will maximize the profits of the company as a whole. That is, what is in the best interest of the company? What transfer arrangement will maximize the profit of the company as a whole? That is the starting point. Next. Having identified the plan that is in the best interest of the company as a whole, identify the transfer price or a range of transfer prices that will make the manager of the buying division to be willing to work towards this plan. The transfer price that will motivate the buying division to be willing to work towards what is in the best interest of the company. Then lastly, in the same way, having identified the plan that is in the best interest of the company as a whole, identify the transfer price or range of transfer prices that will make the manager of the selling division to be willing to work towards what is in the best interest of the company. Please, ladies and gentlemen, you are going to go back and memorize these three. If you check 2020 diets, examiner tested transfer pricing. All the questions were theories. So you are going to go back and try to memorize and understand these steps on how to identify ideal or optimal transfer pricing. What is ideal transfer price or optimal transfer price? That transfer price that we maximize or that we optimize the company's profits without demotivating anybody. That transfer price that we motivate, that we optimize the company's total profits without demotivating divisional managers. Lastly, is what we call international transfer pricing. A situation where one division is in Nigeria, another division is outside Nigeria. The same company with different divisions. Division A is located in Nigeria. Division B is located in Ghana. Division A is buying products from Division B in Ghana. In addition to what we have discussed, where you have international transfer pricing, you are going to look at the tax rates of the two countries. Because differential tax rates, I'm just hoping that this network allows to run and complete the class audio session. All right, if you are dealing with international transfer pricing, be mindful of taxation. Tax in one country may be different from tax in another country. So if you are transferring goods from one division in Nigeria to another division in Ghana, and there's going to be a price for the goods transfer, then there's going to be...
Yes, sir. Yes, sir. Yes, sir.
Well, now it's not giving me. So please be mindful of the tax impact on transfer prices. Then for this level, we can't talk of currency because we have different currencies. The currency in Nigeria is different from currency in Ghana. But for your level, the only area examiner will look at is your taxation. Currency conversion is not included in your PM topic. All right, any question, please? If there is no question, let us go to our study pack. Let's look at question. We only have like 5 minutes. Oh no, 1 hour. Oh, that's the time. Oh. Okay, let me take this question. This question we undo. That contain international transfer pricing. All right, please look at page 92 or thereabouts. Question 4. Niger's group. Please check page 92. Question number 4. Niger's Group Limited. Can somebody confirm this page? Please confirm the page. Please, can somebody confirm the page? Question number 4. Niger's Group Limited. It should be page 92 or 3. Hello. Hello.
Yes, sir. Can hear you, sir.
Hear you, sir.
Can you confirm that page, please? Okay. Let's go on. But I like to confirm the page and be sure. But let's move on with the class. But I always encourage us to open this question as you are going with the lecture.
Excuse me, sir. Good evening, sir.
Yeah, good evening.
I've gone through like my own pack. I've gone through it. I've not seen the one that has this Niger Group Limited. I wouldn't know.
Exactly.
I've gone through
it's
from
not there.
illustration. I've gone from illustration 1 to illustration 6. I couldn't find it.
Okay, maybe I deleted. Oh, okay. It's very possible that in the cost of, but you have spoken out now. Thank you for saying this. Maybe in the cost of updating the study pack. Okay. Thank you for speaking out, Joseph.
Thank you.
It's very possible that in the course of updating the study pack, we remove this question from there. But let's deal with the question. After the class, I'm going to still share the material. This question involves international transfer pricing, a division in Nigeria, another one in other country. So I want to use this question to explain. It covers a lot. So please try to follow the question. Niger's Group Limited has been in operation since 1990, playing a leading role in the automobile industry. Division X is part of the group. Division X, which is part of the group, manufactures only 265 by 16 rim tire. Division X manufacture tire, which is sells to external customers and also to Division Y. Another member of the group, Niger's group policy is that divisions have the freedom to set transfer prices and to choose their suppliers. It uses residual income for performance appraisals. The group's cost of capital is 12%. The two divisions operating data as follows. Budgeted information. Sorry, Division X. Budgeted information for the coming year. Maximum capacity. 150,000 tires. External sales, 110,000. External selling price, 35,000 per tire. Variable cost per tire, 22,000. Fixed cost, 1 billion, 80 million. Capital employed, 3.2 billion. Please hold, I'm trying to shift this up. Target residual income, 180 million. This data is for Division X. Division Y. Division Y has found two other companies willing to supply tires. Ades Limited can supply tires, can supply at 28,000 naira per tire. but only for an annual order in excess of 50,000 tires. Bananas Limited can supply at 33,000 naira per tire for any quantity order. Requirements. Before we go to the requirements, let's explain the question. Division X manufactured tire. This tire can be sold to external customers, or it can be sold to internal customer, Division Y. Division Y can also decide to buy tire from outsiders, external suppliers. We have been given two external suppliers, Ades Limited and Bannerless or Banners Limited. Requirements A. If Division Y provisionally request a quotation for 60,000 tires from Division X for the coming year, determine the transfer price per tire that Division S should quote in order to meet its targets, its residual income targets. Look at this now. A transfer price that will enable Division X achieve a residual income target. We don't care the price you charge, but you must be able to meet your residual income target. Now, please, what is residual income? How do we calculate residual income? Look at the residual income targets. Division Y must achieve a residual income of 180 million. So how do we calculate residual income? If you recall, residual income is profit, operating profit, minus bracket capital employed multiplied by cost of capital. If you recall, residual income is equal to profit before interest and tax minus bracket capital employed multiplied by cost of capital. In this case, you are going to work towards a particular target. If you are to do this question, we are going to do a work back. Look at the work back, please. Examiner says 12% is the cost of capital. Then Calculate 12% of capital employed. Capital employed in this question, examiner says 3.2 billion. 3 million, let me even count it. $200 million. Multiply by 12%. What do you have, please? If you can make it snappy, please. How much will this give us? This will give us 384 million. %12 of capital employed. Now add this to the residual income target. 180 million. Please sum these two together. This is the time to
564 million.
$564 million. 564 million. Let me explain this briefly, because you might be wondering, what are we really doing? Let me try to explain this. This question is long, and I want to complete it. Normally, if you prepare your profit statement, look at your profit statement. Normally, you start with your sales value less your variable cost. That will give you your contribution. Is that not?
It is.
Less your fixed cost. This will give you your profit. Is that not? Now, if I want to get residual income, my profit less capital employed multiplied by cost of capital. If I less this, that will give me residual income. Now, you know the residual income. If I want to get the profit back, residual income plus the figure you get from cost of capital multiplied by capital employed, that will give me the profit back. Look at it. You are doing a work back now. Look at this, please. Capital employed multiplied by residual income. 384 million. Capital employed multiplied by cost of capital, 384 million. Residual income required, 180. If you sum these two together, that will give you your profits. Now, profit plus your fixed cost. Fixed cost of division X. Go and check. What will that give us? $1,080 million. If you add fixed cost to your profit, what will it give you?
Contribution.
Contribution. 1080. 0000. Please add these two together.
1,644 million.
10. Okay, yeah, that's correct. $1,644,0000. Now, your contribution plus your total variable cost. What is total variable cost? How many will Division S produce? Division S will produce 150,000 tire. Variable cost per tire, 22,000. Multiply. $150,000 tire multiplied by 22,000. Please multiply and give me the figure. 3.3 billion. Your contribution plus your variable cost, that will give you your total sales value. Sum up.
$4,944 million.
440000. This is your total sales. Total sales of Division X. These total sales include external sales and internal sales. Examiner says, look at that requirement too. Examiner says, if Division Y provisionally request a quotation for 60,000 tires from Division X for the coming year, that means Division S is looking at selling 60 tires to Division Y. If you agree to sell, at what price will I sell to be able to meet my residual income targets? That means for internal sales, we are going to give Division Y 60. Out of 150, maximum capacity of Division Y That means for internal sales. Look at it, internal sales, 60 tires. Out of 150, you have transferred 60 to division Y. That means you are left with 90 for external sales. What is the external selling price? 35,000. $90 multiplied by 35,000. What are our external sales value? Okay.
$3,150,000,000.
Can I do now? Just try to 3,150,000,000. What you are saying is out of a total sales of 4 billion, total sales that will give me, the total sales that will give us a target residual income is 4,944,000,000. Out of this total sales, external sales value is 3,150,000,000. What is internal sales value? The difference. What is internal sales value? $1 billion, 1,794,000,000. Now look at it. For internal sales, that is sales to division Y. You are going to sell 60,000 tires to division Y, and you are going to generate 1,794,000,000. What is selling price? What is the internal selling price per unit? Quantity sold internally. I'm trying to explain this. Division X, we sell 60,000 tires to division Y, and it's going to generate 1,794,000,000. What is the selling price per tire? That means you are going to divide 1,794,000,000 by 60,000. If you divide, the answer will give you 29,900. That is the transfer price. You know, transfer price is coming from internal sales. Sales from division X to division Y. That means this 60,000 must be transferred at 29,900. If division X is to meet its target residual income, look at it. Transfer price of division X to achieve its residual income targets. Must be 29,900 per tire. You are done with requirements A. You are done with requirement A. A transfer price that is calculated to achieve a specific objective. Deliberately, I try to draw an illustration to be able to carry the class along. Residual income, a workback, plus imputed capital charge. That will give me profit. Profit plus fixed cost will give me contribution. Contribution plus my variable cost will give me sales value. The sales value can be divided into two: external sales and internal sales. Transfer price will be derived from the internal sales. You have answered 9 marks. You are done with this. Requirements A2. Calculate the two prices that division X will have to quote to division Y if it becomes the group's profit to quote transfer prices based on opportunity cost. This won't waste our time at all. First, division X maximum capacity is what? Maximum capacity is what, please? Okay. Maximum capacity is 150,000 tires. External demand is 110. Okay. You come here. Maximum capacity, 150,000 tires. External sales, 110. What is this different call, please? What type of market is this?
Imperfect.
Hello.
Perfect market.
Imperfect market. The difference, oh, sorry, 40,000. 40,000. This is called spare capacity. What is the ID transfer price for spare capacity?
Variable cost.
Thank you. Look at it. 1. 40,000 tires should be transferred at variable cost. ₦22,000. That is one price now. But division Y requires 60 tires. We have transferred 40,000 tires at 22,000 naira. Out of 60,000, we have given division Y 40. The balance must be transferred. That means out of this 110 from external sales, 2, remaining 20,000. Okay, there's no point. 20,000 tires. Because external customer is willing to buy at 35 naira. $20,000 tires will be transferred at market price. So the two prices, look at it. Two prices based on opportunity cost are 1, 22,000 naira, and 2, 35,000 naira. The 40,000 will be transferred at the variable cost of manufacture because it's a spare capacity. Remember, division Y requires 60,000 tires provisionally. That means out of 60, you have gotten 40 from spare capacity. The balance will be deducted from external sales. And that will be at the external market price, 35,000 naira. You are done with that requirement. Excuse me. Requirement B. Evaluate the impact of the group's current and proposed transfer price on the profits of division X and Y. And on the group profits. You don't require any calculation. Look at the expected comments. Because of the, let me increase this more. Let me increase this more. Because of the present policy of judging performance on the single measure of profitability, performance of division X is based on residual income. The comment says, because of the present policy of judging performance on the single measure of profitability, there is the possibility of suboptimality. You know, if you judge my performance on profit only, my attention will be on profits. I'm going to be doing everything, whether right or wrong, to make more profits. Because of the present policy of judging performance on the single measure of profitability, there is the possibility of suboptimality. What is suboptimality? Where divisions are taking decisions not in the best interest of the company. Division Y could purchase tires at 28,000 naira from Ades Limited instead of 29,000 naira, 29,900 from company X, from division X. However, if division S cannot sell the 40,000 tires externally, the group's profits will fall. If division Y decide to buy tire from Ades at 28,000, and division X is unable to sell its spare capacity, total profit of the company will fall. To optimize group profits, goods should be transferred at marginal cost. That is variable cost. But divisional performance assessment becomes meaningless and motivation will fall. If you want to optimize profits, it is better to transfer as marginal cost. But where this is done, divisional performance assessment or evaluation becomes meaningless if I'm transferring my product at the marginal cost of manufacture, then you cannot blame me on performance assessment, and motivation will reduce. This is the expected comment for that requirement B. Please, I can understand that you don't have the question, but I don't know why. I just felt like, let me treat international transfer pricing. I wouldn't know why. Even at the physical class, I don't do this. The question will solve themselves. We didn't touch this. Look at requirement C. Requirement C alone is for 15 marks. Assuming division X and Y are based in different countries, and consequently pays taxes at different rates. Division X at 55% tax. Division Y 25%. If division X has now quoted a transfer price of 30,000 naira per tires, for the 60,000 tires, you are required to determine whether it is better for the group if division Y purchases 60,000 tires from X or from others. You are required to determine whether it is better for the group if division Y purchases 60,000 tires from division X or from others limited. That means, to answer this question, we have two alternatives. You are going to look at if division Y buy tire from division X, what is the profit? Alternatively, if division Y buy tires from others, what is the profit? So we are going to deal with two options. Option 1 or strategy 1. Strategy A, buying from company S, that is division Y buys 60,000 tires from X at how much? Look at this. You have opened your workings. Division X, division Y, the groups. Start with internal sales. 60,000 tires at 30,000 naira. How much will that generate? Okay, we have 30 up. That will give me 1,000,000 800,000. Three zero is up. If you follow option 1, division Y buy 60,000 tires from X. Out of 150, look at the maximum capacity of division. Out of 150,000 tire, division X sell 60,000 tires to division Y at 30,000 naira. That means we are left with 90,000 tires. $90,000 tires for external sales. External selling price is 35,000 naira. $90 multiplied by 35,000 multiplied by 35,000. That will give us 3,150. Total sales. Please sum up. $4,950. Now let's pause. Division Y purchase 50,000 tires from division X. Division Y is based in another country, assuming Ghana. Division Y from Ghana purchases tire from division X in Nigeria. Now the question we are going to ask ourselves is, what will division Y do with the tires? You are going to assume it now. Obviously, division Y will sell the tire in the other country. You can't eat the tire. It is obvious that division Y will also sell these tires at its own location in different countries. And division Y will be selling to external customers. At what price will division Y sell? Division Y must sell at the market price of the company. That means you come here. For under division Y, he has received 60,000 tires. He's going to sell this in Ghana at a rate of 35,000 naira, equivalent to Ghana money. If you multiply this, we are trying to get revenue of division Y. 60 multiplied by 35. 2.1 billion. You are going to assume that if Division Y based in Ghana is buying tire from Division X in Nigeria, it is very obvious that that division in Ghana we sell tires. For internal sales, Division Y does not do internal sales. Total sales here. To the group, external sales plus external sales. Division X will generate revenue for external sales. Division Y will generate revenue from external sales. Total revenue $5,250 00. The total revenue belongs to the group. For internal sales, this will be nil. Remember we said internal sales does not have impact on the gross profits. You have your figure here. You now come to the cost. Please note, when you get to cost, what is internal sales to Division X becomes internal purchase to Y. This 1.8 will come here. Internal purchase cost. What is revenue to Division X? Is cost to Division Y. Please note, internal purchases will not affect the group. Revenue here, cost here, they will cancel out. Variable cost. Division S will produce 150,000 tires at a cost of 22,000. That gave us 3.3 billion. 3084. This variable cost is incurred by Division Y, by Division X, to be able to manufacture tire. For Division Y, no variable cost is incurred because it's going to buy tire directly from X. This variable cost is incurred by Division X. It involves money leaving the company. It will affect the group. Cost incurred by your division, not internal purchase. The fixed cost, let's go check. Fixed cost here for Division X, 1080000. No fees cost here. Total fees cost 1080000. You can sum up your cost. 4,380,00. Your cost here 1,800,000. The cost here 4,380,00. Now your profit before tax. Total sales minus total cost. Total sales value minus total cost value. Four nine 50000 minus 4,380,00. Profit before tax here 570. For division Y, sales minus cost 2,000 100 minus 1,800. The profit here 300. So the company has a whole. Check it out. Total revenue minus total cost 5,250 minus 4,380. Total will give you 870. Now introduce tax. The tax rate in X. Let me show you. Differential tax. Division S at 55. Division Y at 25. Here we have 55%. Here we have 25%. For division X, compute 55% of 570. What is the tax payable? $313,500. $313,500. For division Y, 25% of 300. $75,000. Total tax, add the two together. Total tax paid by the company, $388,500 Now get your profit after tax. For the group, 481,500. For division Y, 225. For division X, 256, 500. Look at the first option. If division Y buys 60,000 tires from division X, the total profit of the group will be 481,500,000. Look at this. Deliberately, I put it in color. I want to draw attention to something here. 481,500. This is option 1. Option 2. If division Y buys tire from Ades Limited, what is the impact on the profit of the company? Look at this. If division Y buys 60,000 tires from Adex, that is external supplier, in bracket, external supplier, at 28,000 naira per tire. What is the impact on the gross profit? That means if division Y buys tire from outside, it means that spare capacity, nobody will buy. Because the maximum demand, the maximum external sales is 110. The maximum capacity of X is 150. If division X is aware that division Y will buy tire from outside, from external supplier, will it make sense for division X to still produce 150,000 tires? I will take that again. I want the student to answer this question. Assuming you are the manager of division X, your maximum capacity production is 150,000 tires. And you are aware that your maximum external demand is 110. You have been informed that Division Y will buy tire from ADEX. My question to the class is, will it make sense for Division Y, Division X, to still produce 150,000 tires? Yes. The class is silent. It makes no sense to produce what you cannot sell. It makes no sense for Division Y to produce 150,000 tires. Because nobody will buy the spare capacity again. In this case, we are going to assume that Division X will limit its production to the maximum external sales. In this case, if you come here now, no internal sales again. We are going to limit this to what? External sales for Division X, 150,000 tires at a rate of 35,000. $150,000 tire, no, 110, sorry, 110,000 tire at a rate of 35. That will give us 3850 00. That is the maximum sales. At 35,000 because of space. That means total sales here 3,850,000. Division Y we buy 60,000 tires from ADEX. At 28,000. Look at it. This will affect Division Y. 28,000 naira multiplied by 6. That is the cost Division Y we incurred. $60,000 tire at 28,000. That will cost 1,680,000. This cost is from external supplier. It will affect the group. You are purchasing tire from outsider. Now ask yourself, if division Y purchase tire, definitely is going to resell. At what price will division Y resell? It's going to resell at the market price. That is 35,000. If you multiply 60,000 tire by 35,000 naira, you are still going to get 2,100,000. Total sales of division Y. No more internal sales. Now sum. Sum the two together. 385 plus 1200. That will give us 595,000. Total 595. I'm almost done. Variable cost. Only division S will incur variable cost. Now, production has been limited to 110. That is, division S will only produce 110 at a variable cost of 22,000. $110 multiplied by 22. 2,420,000. This cost will affect the group because it's not internal purchase cost. Fixed cost 1,080,000. Only division S will incur fixed cost. Get your total cost. 1680,000. Plus 1080,000. Total cost here 3,500. Total cost here for the group 5,180,000. I hope I'm right. It's not even impossible. Students are sleeping.
You're right, sir.
The class is unusually quiet. our profit. For division X, get the profit. This is 350,000. For distribution Y, get the profit. For 20,000. For the combined company, get the profit. 770. That is profit before tax. Now introduce tax. 55% here. 25% here. $55% of 350. 192,500. $192,500. Tax payable. $25% of 420. 105. $105. The combined tax $297,500. Get your profit after tax. Yeah, I have 472,500. What do you have here?
Division Y is 315,000.
315. Yeah. 315. X.
157,500.
We are done with the two options. Now our decision. Compare the group profits. Look at it. Division Y buys from division X. Profit is 481,500. Division Y buys from ADEX. Profit is for the group 472,500. What is your recommendation? Which one is giving the company the higher profit? Recommendation. Division Y should buy entire from division X so as to maximize in order to maximize the company's total profit. You are done with the question.